Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to and Yellow Tunnel. Today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions, strategy, how to trade in current markets, Tradespoon technology, Yellow Tunnel content, and any other questions you might have about Tradespoon or your Yellow Tunnel subscription. So I encourage you to enter questions about both. In terms of bio, this is my brief bio. I was Executive Vice President and Head of Technology at Options Express from 1999 through 2007. Options Express was an online broker-dealer acquired by Charles Schwab in 2010. Since I left Options Express, I work as a consultant and investor in several financial technology firms here in Chicago. Started Tradespoon in 2012, started Yellow Tunnel about a year ago. So I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money, mentoring and teaching Tradespoon subscribers how to trade stock and options. And finally, my latest passion is trading psychology, and hence the Yellow Tunnel. Disclosures, trading stock and options involve risk and are not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, it should not be assumed that future trade picks will be profitable or will equal past performance. Carmen, Osama, Bill, good morning. Right, before we talk about trading system, let's talk about current market conditions. Spiders is fluctuating between gains and losses. I think short term, we have set the top to 64. So the way I'm looking at the market, for bulls to continue rebound in this bearish market, bulls need to break the 264 side, 64 overhead resistance. This is a long-term overhead resistance. Let me zoom in so people can see it better. All right, hopefully you guys can see it, but 264 has been overhead resistance. This was support in October 2018 and November 2018. This is where the market stopped trading. It represents 38% retracement. If you go from recent lows to recent high, 38% retracement used to be overhead resistance in October, December 2000. So it's a meaningful overhead resistance. For the bulls to continue rally, market has to break through the 264 side. On the other hand, for the bears to retest the lows, they would have to break 240, 237 level, right? The 240 is where we had the last strong second day of rally. Also represents 50% retracement between recent highs and recent lows. So right now, you can see volatility is dropping and market is trading in this narrow range. Despite the unemployment numbers, actually I stand corrected, so it was 6 million new unemployment, unemployment claims that were filed last week, and 3 million prior, so we have 9 million of new unemployment cases. Today, the monthly unemployment numbers came out worse than expected, 700,000. Obviously, they don't reflect the last 2 weeks of jump into unemployment numbers. So the next unemployment numbers that will happen, when we report May, will be. But market hasn't reacted to the unemployment numbers. It hasn't reported to what I think is a positive PMI, right? PMI surprise. Instead of 45%, we're still in expansion, above 50%. So market is waiting, right? I think people just tired from the volatility. You can see the VIX is dropping. So market is waiting for the next set of news, which is back to coronavirus, right? Unfortunately, the spread of the coronavirus is increasing. We have 245,000 cases in the United States. The positive news is that from one of the blogs that I read that, and we'll have confirmation today during the briefing, but today the number of people entering hospitals in New York was less than the people leaving, the hospitals in New York. So even though the situation is still dire and a lot of people are dying, just from the trend perspective, that is the positive news from New York, that obviously if more people leave the hospitals than enter the hospitals, that gives an opportunity for healthcare personnel to treat people and minimize the number of deaths. Another positive news, Spain. Again, you can see obviously a lot of cases, too many deaths, but in terms of trend perspective, you can see it's flattening. It's not making new highs in Madrid and overall Spain. And I thought that this is also encouraging. The number of new cases is dropping, but the number of new recoveries are convergent, right? We have more people recovering. Number of new cases a day are flattening. So this is also a positive, I think is a positive news. And same thing in Italy, not same thing, the recoveries I wish would be better, but at least in terms of making new highs and making new lows, you can see that number of new cases per day is dropping, right? Unfortunately, the number of recoveries is not moving as fast as everybody would hope for. So I think that's the next level of direction, right? Either we have a positive news, and the positive news from the spread of the coronavirus is more than the negative news, and you can see that market will break the 263 side. So that's my view on the market. I think traditionally, with all these corrections, looking at December 2018, if we will go back to 2008, all the corrections, especially with this type of magnitude, the lows retested once, sometimes it's retested twice. So I would anticipate, just based on the history, that in April and in May, we will retest the low several times. Until then, I would be maybe market neutral, right? We're closer to the overhead resistance. So I would start getting, as we approach into 260, I would be more bearish. As we approach into 220, I would be bullish. If you're a long-term investor, I would buy, I don't think we're going to have a prolonged recession, right? I think actually I was looking at the model, just ran the long-term model on stock forecast toolbars. Actually does outline what I would say is, confirms my opinion at least, of a U-shaped recovery. So if you look at the 6 months prediction for spiders, every candlestick here is 1 month's worth of data. So we're analyzing, as much data as we have. I think, what does it start at? 1994, right? So we analyze all the data points, and basically says that, I would say average price in April is 264, in May 275, in June 287, right? And then potentially, drop in the price. But purely from price action, from what happened in the past, in the past 20 years, it does outline the U-shaped recovery. If we are average price in April 264, average price in May 275, average price in June or July 290, then I think that if we can break to 60 level, if we can break to 80 level, then bulls, then this is a U-shaped recovery, right? We can trade in this range bound trade, and as long as the market below 200-day moving average, I would be bearish on the market overall. But we're gonna, we're making higher highs and higher lows. So I think that's a U-shaped recovery, and potentially by the end of the year or Q4, depends on how well the small business loans program is working, right? Millions of people applying for the unemployment. Millions of businesses are applying for grants and payment protection program. If that program works well and quickly, then I think we can reclaim 200-day moving average by the end of the year. But short term, I would expect, again, retest of the lows, potentially overshooting the lows, depend on the inflow of the news. But I would expect this kind of price action, potentially in December, right, on the bad news, if there's more bankruptcies or we have spike in the coronavirus cases or second wave of the coronavirus cases, I think market can overshoot, 10%, right, just like we had in December 2018. But it'll probably be something short that lasts a couple of days, and then the market recovers. So that's my scenario of how the market is going to trade, right? What happened in 2018 started in October, and by March, April, market start rallying, and that's one scenario. Again, that's the U-shaped recovery. I would not dismiss the recession scenario, something that happened in 2008, right, where market it took from the lows from August 2008 to reclaim the high was it took, I don't know, 5 years to 4 years to retest the highs. So that's deep recession, from 2008. I think what took months for U.S. government to institute liquidity and sending paychecks and government programs, what took months now takes weeks. So from that perspective, I don't think we will have this scenario. I would not dismiss that. At least I would always go through your cash position, make sure on average 30% of your portfolio in cash, that you look at your portfolio drawdown and realize that this scenario is also possible, right? I personally don't invest my money right now with assumption, assuming that we're going to have a deep recession, but it's possible, right? It's not something, there are enough people right now in the stock market that do believe we will have something like that, multi-year recovery as opposed to multi-month recovery. I believe, Q4 of this year, Q1 of the next year, we will reclaim 200-day moving average, which I think is the best case scenario, U-shaped recovery. So what are other positive or negative news? Oil, I was watching oil again. I think this is very constructive price pattern in oil futures. We've reached 20 level. Again, there's an oversupply in the oil market, and there's definitely a bear case, but purely from price pattern, this is again a sign of bottoming process. I don't think oil is going to collapse and drop to $10. I mean, it can obviously overshoot to 16 and 17, but China is slowly, buying energy. And if you do believe in U-shaped recovery, then I think this is probably close to the bottom. Maybe overshoot to 10-15%, but again, from risk versus reward, by end of this year, oil can go back to 60 level, right, or Q1. But to the downside, I think the worst case is 15. So you have 15 points to the downside, you have 30 points to the upside. I would be patient, I think it's going to take time to break through these overhead resistance, but any meaningful pullbacks, if oil drops to 20 level, 22 level, I would consider buying. So energy is giving support to the current market. So where would the sell-off come from? I am looking at the junk bonds, right? We had a pretty meaningful recovery, 50% retracement. We're dropping junk bonds. If there's more if the recession is prolonged and people are not going back to work in May, if the lockdown is extended to end of May, end of June, then obviously there will be more companies, larger, smaller companies going out of business, and distressed debt is something that can pull the market again, retest the low or breaking, depending on the flow of the news. And the other thing is I would keep an eye on technology, Apple specifically. Apple has been underperforming the market on the up days, on the down days. I think there's still a lot of people that hold in, Apple and Microsoft and Google, and you can see these companies are underperforming the market. Adobe, Netflix, Google. So that's another way of the sell-off that can come. So I think the strategy, at least mine, if you're a long-term investor, buy into the sell-offs and be patient. I think there'll be several opportunities for the market to retest the lows. There is enough dislocations happen in the market where this is not something that will take 2 weeks and the market will recover. It will have to take, best case scenario take months. Worst case scenario takes years. All right. World media, yes, Kevin. So Italy, Italy, dire situation. But from, if you read Wall Street Journal, you read something in the news, you can see that at least not every region of Italy, not maybe Lombardy, but Rome and south of Italy, that people leaving the hospitals are higher than people coming to the hospitals. And unfortunately, these recovery rates should be higher. But at least, we've seen, lowest number of new cases in the last 13 days, right? 4,000 cases. So there is a tone of optimism happening in Italy, right? So that's a good sign. Obviously, they're still on the lockdown, and potentially, they might be in the lockdown until this chart converges more. But I think that's a positive news. Spain, I'm not sure if this is maybe just an error in data point. I would not get overly excited. But the fact that, we have jumped, there's 4,000 recoveries on April 7th, 33,000 recoveries, 3,300 recoveries on April 3rd, and the number of new cases is flat. If that pattern continues next week, then at some point, again, number of people that come to the hospital will be less than number of people living in the hospital. That is the main driver. New York, from I've read, I couldn't find a reliable source, but from what I understand, yesterday, same situation happened in New York. Number of people leaving the hospital was higher than the number of people coming to the hospital, and that's what everybody's waiting for. If we are in May, the number of people going to a hospital is higher than the number of people living in the hospital, then this is going to be a multi-year recession. But if by end of April, these numbers converge, then I think this will take a couple months to reclaim. Kevin, thank you for the question. Joseph, my view, if you believe in U-shaped recovery, right, then yield has reached its lowest point, right? And yes, Treasury can continue going higher, but I think at this point it's set the high. Again, so if you look at risk versus reward, maybe if we have a second leg to the downside, and at some point government is going to start buying back treasuries, right, in large amounts, I would assume Treasury can potentially go to 179. But if the U-shaped recovery is in place, at some point interest rates will stabilize and people will move money from treasuries back into equities, right? It will be tug of war. How much treasuries does the government need to buy, which they already done enough, right? You've seen it go from 140, 168. This is US government buying treasuries. This is not, Vlad is buying treasuries or retail investors. So I think there is more room to the downside in treasuries. So if you believe in U-shaped recovery, I would be cautious about buying treasuries at this point. If you think it's a multi-year recession, then I think that's where people would hide their money. But at this point, my perspective, there's little room to the upside, 10 points to the upside. I think there's a 30 points to the downside, in the next few months. So that's long-term perspective. If you're doing day trading, you're taking long position. Yeah, long position 153, I would rebound. I mean, I'm personally in opinion, if it's a long-term position, I would rebalance. But Trading on the news short, but I don't believe trading on the news short term. I don't, the problem is trading on the news short term can be very frustrating, right? I believe, at least when VIX is dropping, right? The biggest thing is VIX. Right? VIX has continued to drop on up days, on the down days, lower highs, lower lows. This means that there's no panic. If there's no panic, market trades based on technical analysis. Trading on the news, unless you're a big hedge fund and you can just do large trades and you do trading, you can see that could be very frustrating, right? We had horrible unemployment numbers yesterday, market moved up. We had, and plus you cannot predict the when will this news come. So trading on the news to me does not make sense. I usually try to stay away on the news, trading on the news. I would only trade on the news if I see a breakout of key support and resistance level, right? At some point, there'll be positive news. Number of cases in New York are dropping, and the market will break above to 64, right? It's just a matter of time. It can happen next week. It can happen, 2 months from now, but at some point it will, right? So once you see the news and the market broke through the main support levels or resistance levels, then it makes sense. But on short-term trading on news, you're trading against large hedge funds that have a lot more technology, and and personally, that's why I like to trade spreads, and I like to trade market neutral strategies, or you can express your bias. Let's say I'm bullish right now. So if the market sell off, I can do a vertical spread because I'm expressing my bullish bias, but I have short and long position that I can trade because I cannot predict manufacturing number that it had a positive surprise, and I cannot predict that as a result of that many positive PMI numbers, the market is going to be down 1%. And if you can do that, which I don't think you can, but if you can do that, then it's great. So Bob, that's my view on the news. I always ask myself a question: is this a new news, or is this kind of is it new old news, or is this new news? The fact that you've seen yesterday unemployment numbers, everybody expected 3 million, but we had 6 million, and the market is at the same point, just tells you that there's no way anybody can predict the news, right, or trade on the news, unless you're a big hedge fund, you have technology, and you can, just, look for small price fluctuations, maybe day trading. But still, even if it's day trading and small price fluctuations, I encourage you to try, instead of trading on the news, trade on the support resistance levels. You can see clearly as market approaches 240, it bounces back. As market approaches 260, it bounces down. So, and this happens on, almost on a daily basis. So those are your key support and resistance levels. And I think this is more effective of trading. Is day trading effective? You can see that right now market is trading in equilibrium, right? It's kind of, 260. We've reached several times. I would go long, I would go short. 240, I would go long with a very clearly defined stop orders. So you can definitely day trade when you see these support resistance levels, but I would not do it because, we have unemployment numbers. I would stay away from the news of unemployment numbers. Once unemployment numbers come out and manufacturing numbers come out, then you can trade. If market drops, well, today is Friday, so it's kind of different. I would not hold the position, day trading. I would not hold position overnight. I mean, over the weekend, short-term position. But, we'll see what happens next week. But, I would assume volatility will pick up next week. Best case, I think for the bulls, the best case scenario is that we get it over with this expectation that we will retest the lows, right? Everybody thinks that we will retest the low. Everybody believes we will retest. Not everybody, but trading community. A lot of traders, including myself, are waiting for this retest, right? So the sooner we have this retest and bounce back above 264 side, that would be a win for the bulls, right? We test 220, maybe we drop to 215, maybe we stop at 225, we bounce back and we move above 264. That is a win for the bulls. The sooner it happens, the better it is. If this happens, end of May, that's not a win for the bulls. But if it happens next week, that will be a win for the bulls. Dollar, I would keep an eye on dollar. Obviously, it's not good for dollar to continue to go high, but you can see it dropped significantly, right? So it's rebounding back, which is expected, right? This is just laws of physics. You know, if you drop a ball from the 9-story building, once it drops to the first floor, it rebounds back, right? So it's just a matter of potential energy, right? You look at potential energy and kinetic energy. The higher the potential energy, the higher the rebound, right? But the good news, these fluctuations are decreasing in size, and we're not breaking 103, we're not breaking 95. So this is just the government, providing liquidity to sovereign, funds, and at some point, just like Treasury, it's finding, when the amplitude of the move is decreasing, right? And we see sense of stability. So that's good. All right, we have a lot of attendees today. Love it. Okay, thank you. Yellow tunnel. Again, I think especially if you're trading on the news and you're trying to predict the news and you're trying to move based on the news, market is extremely frustrating, right? If you're trading on support resistance, then it's still frustrating because it moves very quickly, but at least, for the past couple of weeks, it has been pretty calm from my point of view, right? With trading in this relatively narrow range, and you can regroup, you can think about your long-term, short-term goals and regroup. But volatility is still in unprecedented levels, right? Last time we had this volatility was in 2008. I encourage you to look at Trading Discipline webinar with Dr. Maneker, right? Last Wednesday of every month we have a live trading session, and if you haven't seen, how many of you have seen this recording, and how many of you have not seen this recording? So out of curiosity, if you can just type in how many people. All right, 1, 2, 3, yes. All right, no, okay. So funny, no matter what question I ask, I always get 50-50 responses. Okay, so for those of you who have said yes, thank you very much. I do appreciate your support. I don't take it lightly, especially when everybody's locked up in their house. Actually, very thankful and fortunate that we have a great community of Tradespoon and Yellow subscribers. So I mean it from the bottom of my heart that you guys do come out and watch this videos. If you have not watched this video, it's okay. Not a big deal, but by next Friday, please make sure you do watch this video. If you haven't looked at trading psychology, if you haven't traded long enough, if you don't, at least from my experience, whether it's 50% of success, 40, I don't know what the number is, but the big percentage of your success is how you trade inner market, not the news that comes out, in terms of unemployment numbers, PMI numbers, or how much oil Russia will or will not supply. Half of the time, your success will determine how well you will handle when the market moves 20% and you're overwhelmed by fear of missing out, versus how much you will be overwhelmed when the market drops below 220 and it's 215 level. Those two extremes, when they happen, and they do happen, not often, but they happen, especially lately, they happen more often than not. How well will you manage your inner market, your emotions, and how much cash you will have at those extremes, and what will be your portfolio drawdown? So for that, you need to be self-aware. Your emotional IQ, right? Your emotional IQ has to be high, right? Or at least you have to train yourself. Some people it comes naturally, some people it's just like anything else. They're good at this, some people are not, but that doesn't mean you cannot train yourself or teach yourself how to deal with emotions, how to be confident, and how to be self-aware. At least when you enter in position, you can write down in your trading journal, I'm entering position because I'm afraid market is up 20% and I'm just gonna miss the train. You have to write that down in your journal, right? And so I encourage you to watch these webinars. Obviously I cannot explain in the next 10 minutes trading psychology, but this is the reason why I built the yellow tunnel, because I truly believe that in order to become a successful trader, you have to master your inner market, and you have to have tools that at your disposal, especially if this is something that is not coming to you easily. So we have a lot of webinars, trading plan, trading discipline, trading analysis. I encourage you to review this webinar and many others that we have with Dr. Maneker. He's a clinical psychologist. He's a professional trader. He's not just a psychologist who never traded, and he has kind of just a lot of theory and a lot of maybe lab results, but he also has practical applications. He does this full time. He does it for a living. And he trades and manages, works with a lot of traders. So this is something that is very unique and it's very hard to find. And I encourage you to do this. All right, so that's yellow tunnel. That's the current market analysis. So if you watch this video or previous video with Dr. Maneker, one thing that I learned is that you should, instead of concentrating on predicting the news and getting frustrated when the news goes one way and the market goes completely the opposite way, concentrate on things that you can control. And what we can control, what I control, is how much cash I have in my account. Depending on your background, on average, 30% of your portfolio should be in cash. If you're 100% in equity right now, I think that from my perspective, that would be a mistake, long-term or short-term trader. Or if you're buying on margin, I think that would be a mistake. If you're 100% in cash, I also think that would be a mistake, whether you're a long-term or short-term trader. So, talking to your financial advisor, figure out what's appropriate for you. We all have different background. I can tell you what on average is. I can tell you what I am, but we're different. But I think extremes are probably, from my perspective, are probably not the right approach. So control things that concentrate on things that you can control. The other thing is portfolio drawdown, right? You could be the biggest bull and you can believe in V-shaped recovery, and this is great. And I'm very optimistic when it comes to that. I don't have a lot of patience. I do have that alpha type personality, getting from point A and B in a straight line, very impatient by nature. But these rules kind of keep me in check for the most part. And portfolio drawdown, right? I always go through these scenarios. If market breaks 200, how much cash will I have, and what is my portfolio drawdown will look like, right? If market breaks through 280 level, how much, what will happen to my hedges? What will be my portfolio drawdown? So those things I can control, right? Anybody can control them, and that's what I'm concentrating on. I'm concentrating on support and resistance level. I do have to have a outlook on the market. I explain my U-shaped recovery outlook. I'm studying, I'm looking carefully at the oil, at small cap stocks, treasury, VIX, gold. So it's important to understand, have, sense of direction outlook. I don't have to be correct, right? If market doesn't break to 64 in April, or 280, if it doesn't break 280 by May, but it breaks it by June, or July, that's also going to be positive, right? I don't have to be 100% correct on these support and resistance levels, but I have to have an outlook, right? At least whether we're entering, multi-month recession, multi-year recession, or whether, we have, entering multi-month recession. Set your trades based on favorable risk versus reward. I think classic example is oil, right? Oil, I think, is a classic example where right now, to the downside, you have 15 points to the, if you're long-term investor, right? We're talking about multi-months. And, this is not day trading. I'm talking about, outlook to Q1 of, end of Q1, end of the year, the beginning of the year, and potentially to the upside 6. So you have 30 points to the upside, 15 points to the downside. You can trade verticals, you can buy the dips, or you could dollar cost average. There's a lot of approach, but you have to have that outlook. If your outlook in the next 2 years will be 15, and the maximum is 35, then you do reverse, right? You you build bearish scenario. But you have to have an outlook, and you have to structure your trade, whatever the outlook is, on a favorable risk versus reward. JP Morgan. We're approaching earnings season. Obviously, low interest environment is not good for the banks. Low interest environment might stay here for the months, but same thing. You can look at, maybe you have, 60 points to the upside. I mean, downside, maybe you have, I don't know, 16 points, maybe 20% from this point on, JP Morgan can drop. So if you're long-term investor, you can structure your trade kind of in that scenario where, I would not change, I would not put all my money into JP Morgan, but maybe put half a position now and put the second half if it drops to 72 or, 65 and along those lines. So risk versus reward is something that we can control and very important to do. Okay, so the goals for today is to look over the tools, how to understand how to lower your cost basis. You don't have to buy JP Morgan. You can buy JP Morgan and buy JP Morgan put spread or JP Morgan put, right? You can do merit put, you can do collar, you can express your opinion, but always protect on yourself in case, you're wrong, at least on timing, right? I mean, I know I'm right on JP Morgan that it will reclaim its highs. So the question is, will it take 4 years for JP Morgan to reclaim the highs, or will it take 6 months for JP Morgan to reclaim the highs? So the timing can be expressed in terms of the strategies, right? You can buy a put spread and protect yourself on JP Morgan, right? Kind of what I did. If you look at the elite trading circle, right? So at Tradespoon, Tradespoon, we are synchronized with my account, right? So you can see with XLF, I decided to trade XLF because we're approaching earnings season. And so, but I'm buying stock or ETF, right? So I'm buying ETF, bought it at $18.74, but at the same time, I realized that short term by May, we're not going to reach the high, right? So I'm hedging myself. I'm hedging with the call spread, bearish call spread. I'm also hedging with the bearish put spread, and I'm trading around this position. When market sells off, I reduce my portfolio delta. I'm reducing my short positions, and as it rallies, I'm reducing my long exposure, right? By closing either the short calls or the short puts and reducing that exposure. So this is an example, one of the examples where you can have a very bullish V-shaped recovery, but just in case you're wrong, and in case the timing doesn't work out as well as you plan, you always, whatever your estimates are, you always multiply by 2. My background is building software. I've been doing that for more than 20 years. So I know that when I want to provide an estimate, it's kind of industry standard, just multiply by 2. Same thing. If you think the market will recover by July in 2 months or 3 months, well, just multiply it by 2 just to be on the safe side. So don't buy July calls, buy September, buy January, just to be on the safe side. All right. Kevin, appreciate your thoughts. All right, Carmen. So yellow town on the Tradespoon, not all the recordings, everything is synchronized. So usually if the content has to do with trading psychology, it's only on yellow tunnel, right? So you can find these recordings on yellow tunnel. We do have aggressive power trader portfolio. This is a paid service where if you want to, there's a market commentary. So I provide daily commentary. If you've seen my commentary for short-term traders, I provide it on daily basis. So you get my outlook on daily basis for aggressive power trader. with key support and resistance levels. Plus, you get additional stocks that I think short-term can outperform the market, right? Like you've seen Citrix or Regeneron. So there's more trade ideas for short-term traders. And the other thing is the market commentary, which I think for short-term traders, since market moves on daily basis, I think it's just more detailed and has a lot more details. So that's paid service. But you know, strategy roundtable, some of the educational content on options, technical analysis, fundamental analysis, this is you find on Tradespoon. So thank you for the question. I do look at DIA. I look at the ETF. I don't look at the futures, but you know they're highly correlated, right? TJ, Yellow Tunnel, the aggressive power trader. This is a paid service. You know, we're adding few paid services, but on both sides, I believe that education, you know, unless it's one-on-one training, we do have paid services for one-on-one training, but otherwise, everything is free in terms of the blog, right? Power Trading Markets, I think, is a great blog. Every week we discuss, you know, different sectors, right? You can see this, you know, commentary, more detailed commentary. You know, these services are free. So the webinar recordings, you know, since the inception for the past 8 years, we never charged for webinars or content. And, you know, on some sites, similar content would cost thousands of dollars. I believe, you know, I'm very passionate about education. I come from family of educators. You know, my mother is piano teacher, my sister is physics teacher, math teacher. I used to teach computer science. You know, so I really enjoy the education part. So it's free. I want everybody to have it and review it. And you know, we do have one-on-one services for, you know, if you need. Obviously, there's only so much you can learn in 1 hour. So if you need one-on-one coaching, we do have that, and that's available. Faye, you can read the screen? All right. So just remind me, all I did is I just made it 175%. Usually I'm at 125. So I made it 175. So that's good. Yeah, so Carmen, yeah, we do have on Tradespoon, we have elite service, right? This is if you want to get, every time I trade any of the services, you get email and SMS message. So that's elite trading circle. Robo Investor is just stock portfolio. You can buy it as a standalone service, or it is part of elite. It's also part of premium. Now we also have a premium portfolio. So we have 3 portfolios, live portfolios, where you get email and SMS message every time I trade. So that's the difference. Every time I would place a trade, it's reflected in the trader's log. You get an SMS message, and you can see it live. That's elite trading circle. Same thing, premium portfolio, you get email and SMS message every time I trade. Robo Investor, you get email and SMS message every time I trade. In Yellow Tunnel, at least for now, you don't have, you know, you get commentary and you have provide you list of stocks, but you have to decide if to buy and when to buy, right? This is just more commentary, more geared toward short-term traders that trade more often. And you also have more stocks to choose from with these key support and resistance levels, right? We just released a feature where you can actually go to portfolio history and see, you know, what were the symbols on, you know, the day before, you know, and you can actually view that on daily basis. Right, different sectors, different support resistance levels. You can see the what were the current predictions, what are the historical predictions. We're going to release options data short, so you can see short options, but those are the different services. Again, I understand sometimes can be overwhelming, you know, how many services do we provide, and you know, the very common question, why don't you just provide one service? But we're all different, right? We all have different background. We have a lot of people who are just day traders. They don't care about the robo investor. It's completely irrelevant to them. We have a lot of people who are long-term investors who love robo investor, you know, long-term trade. We have people who trade options. So first you have to decide what you like to trade, what what your trading psychology is. What is your risk tolerance? Are you a short-term trader? Are you a long-term trader? And then you can pick what the service is appropriate for you. We always have a support, right? You can always schedule one-on-one consultation on both sides, right? You can schedule, it's the same support team, supports both sides. It's the same company, same founder. Is just, I want to make a distinction between, trading. Some people don't believe in trading psychology, which is surprising to me, but that makes sense when volatility is low. All this, fear of missing out, it becomes irrelevant when VIX is low, right? And most of the time, VIX is low. Right? Most of the time, VIX is 12, 15, 20, and people say, why do you need psychology? Well, you need psychology when VIX is at 85, right? How often does it happen? It happens, once every year, once every 2 years, once every 10 years. You can see these spikes in volatility. When they do happen, when you do have these dislocations, that's when I think, today is actually a perfect example. I think we have a record number of attendees today, so which is great. How many, in terms of spread, how far out you need to trade? Well, it depends on your type of trading, right? There's no kind of cookie cutter answer. I showed you an example of XLF that I'm trading, and this is long-term trading, right? So long-term, I selected for XLF. Well, I bought a stock and I bought May as a hedge, right? Because short-term I'm bearish. But let's say utilities, this is a long-term bullish spread. Again, I'm giving myself more time, so I'm trading September. So long-term position, I'm bullish, I'm trading September, January. Short-term, like QQQ, where I use for hedge, I actually buy, either by April or May. Right, so that depends on short-term or long-term outlook. Some people teach not to add to losing trades. Why do you advocate dollar cost average? This is more for long-term trading, right? For long-term trading, I advocate dollar cost average right now. This is not for short-term trading, right? If you're day trading and the market moves against you, don't just keep adding to your lose position. You have a well-defined stop level, right? If we're talking about day trading, right? And basically my outlook is 240 support, right? So you can say, well, there's 10 points to the downside, 260 overhead resistance, we're 50% retracement. It's a flip of a coin. But let's say you decide that support is 244 and you enter a vertical spread, you long, right? And then you wait. Now let's say the market drops to 243, 242, 240. One school of thought, okay, you can put the second half of the position at 240. That's what I usually do. But I have a well-defined stop levels. If the market drops below 240, I would exit the trade, right? If the market drops below 240, I would exit the trade. You don't, what I think you're referring to is that a lot of people would advocate don't keep adding to your loose position, because if the market drops to 240, it can drop to 230 and it can drop to 220, right? So depending on your time horizon or even short-term trading, right? If the market, if you enter long position now, which I would not, but if you do, we have a clearly defined short-term is 243. If the market drops to 243, it will probably drop to 240. So short-term, don't keep adding to your position that went against you and violating your stop orders. Your stop orders should always be intact, right? 1% short-term trading, maybe if it's a weekly trade, it's 2.5%. I was talking about dollar cost average for long-term trading, for more of investors, right? You don't know if the market is going to drop to 220 or to 280. So if you're a long-term investor and your time horizon is, months or years, what I'm referring is if you want to allocate 5% of your position, do it at 248. But let's say you put 10% stop order right now. It can happen, in 2 days. So a lot of people would get their stop orders would get executed. So right now, if you're a long-term investor and you're there for a long term, then I think dollar cost average makes more sense. Let's say you don't trade options, you don't buy your put spreads, or you don't hedge your position. So if you buy market at 248, then you realize that there is a high likelihood that the market can drop to 220. You don't want to be in a situation where you buy at 248, and if the market drops to 220, your stop level gets ordered, and then you exit the position. If this is your type of trading, then you probably don't want to buy at 248 right now. You want to at least wait till it drops to 240 and then have your 10% stop trade, because entering spiders right now with 10% stop loss, I would probably not do that, right? Because market can drop 25 points, next week. So that's what I'm referring to as a dollar cost average. But Chris, very good point. You definitely have to have your stop levels, right? Just like in long-term trading, I'm bullish, but if I see that the market drop below 200 level or below one, we have a lot of support in 2016. I believe the worst case scenario, we're going to drop to, below 180 if it's a, multi-year recession. But if we break 180, I would have to go back to my even long-term investment and rebalance. I would have to raise 30% in cash again, because this would be a 50% drop. And that means it's a multi-year recession. So at that point, I don't want to do dollar cost average and keep buying at 180, keep buying at 160. I'm going to run out of cash. You do have to have your stop levels and realize, well, you can buy at 248, maybe buy more at 220, but if it drops below 200, whatever your stop loss, then you exit them. You go back to the drawing board and you evaluate the news and what happened in the market, and you got to raise cash, right? You have to have 30% of your portfolio in cash. Government comments, just saying that with more bad news on coronavirus, I expect market to dip momentarily. Okay, could be. I would watch 240 level. Right now we are fluctuating between positive and negative news. Media does want to only concentrate on negative news, but I would watch 240. I think as long as we're above 240, there is no new news. This is bad news, good news, but market already factored in. If we break through 240 level, I don't think it's going to happen today, but next week, if we break to 240 level, then I do expect retest of 220. Undershooting, overshooting, don't know, but then 220, we will retest 220. Yeah, so we do have a training. If you go to Tradespoon and you go to live event recordings, all the events on Tradespoon side, all the events on Yellow Tunnel are recording. You go to Strategy Roundtable, Active Investor Workshop, you type in spread, right? And then you will get all of the recordings on the spreads. Calendar spreads, butterflies, verticals, all of this you can watch. Carmen, thank you very much. How much money you should have to trade with Yellow Tunnel or Tradespoon? I can tell you on average in the United States, and this is a statistics from a few years ago, but average account is $10,000, right? People who trade options, stocks, it's $10,000. Can you trade with less? Yes, you can, right? But in general, you want to allocate 5% of your portfolio per trade. So if you trade in options, $10,000, 5% is $500. So on most of the time, you can just buy one contract, maybe two contracts, depending on what options you're buying. So, can you trade with $5,000? Yes, you can. You're either gonna not trade all the time or look for, $1 options or $2 options, or you would have to risk more. Instead of 5%, you would have to risk 10%. So as long as you understand that, if you're risking more than 5%, if you're buying long options or vertical spreads that cost more than $500, and you have less than $5,000 in portfolio, realize that you're risking too much. Obviously you can make more money, but you're also risking more money. You cannot trade options with 500. I don't think that's possible. But you can trade it with 2,000, 3,000. Just realize that you're taking more risk than you should, and this is more of a kind of just or you have to be very patient and only trade, verticals. I think verticals would be great for a smaller size account. I would trade verticals, but you would have to have stocks like I'm doing XLF, right, where it's a small size account. I'm buying stock that's only, $20, and some of these options trades, they're 17 cents, they're 70 cents, and these are $3 spread. So one contract, well, here's $5. So one contract, you're risking $500, right? Notifications here come instantaneously. I mean, obviously it's SMS message, but as soon as the trade occurs, you get SMS message. The difference between premium and elite is this feature. The trader log, the real-time access to all the trades, not just premium or robo-investor, but all the trades. Sometimes I hedged overall portfolio, right, like with QQQ. The only way to know that, it's either you're in the live trading room or you have access to the trader log with email and SMS message. So Elite is the only mechanism where you can see all of my trades real time, right? Robo Investor, you see my trades, you get email and SMS message, but it's only for Robo Investor, only when I trade stock. When I hedge my portfolio buying QQQ spread, you have to be either in a live trading room, or sometimes market drops outside of the live trading room, then I would put on a hedge in between, especially now that the market is volatile. 5 minutes it's up 2%, 1 minute, 10 minutes later it's down 2%. I can't wait. This is my live portfolio, and I try to do all the trades during live trading room, but sometimes I do them outside, right? Like lately, it's been the last 15 minutes of the trading session, right? That's where majority of the volume comes in, and this is where a lot of trading happens. Diego, yeah. So if you're a long-term trader, why not testing? Why not? This is all trading, and this is something you need to understand. But the question is, if I believe that the spiders dropped to 220, why would I buy it at 248? That does not make any sense. Completely agree with you, but I'm going to tell you one secret. Nobody knows, including myself, whether the market will or will not reach 220 level, right? Trading is about opinion, observations, analytical tools, but you create a scenario, positive, negative scenario, based on your experience, based on the technical analysis, and you invest money based on your opinion. It's nothing more, it's nothing less than just an opinion. Some people have more experience, some people have less experience, but nobody knows. You will not find anybody, and if you do, if somebody tells you, well, I predicted this downturn, maybe they did, but did they predict it? How accurate were they in predictions every single time, right? Nobody's 100% accurate. Some people are accurate 75% of the time. You can see in my live trading performance, I'm accurate 3 out of 4 times. 3 out of 4 times I put on the trade will be successful, right? So then it becomes a question, how do you manage your losing trades? You don't want to make that one losing trade, you can lose more than in 3 winning trades. That's one point. The other point is that nobody knows with 100% certainty, and I don't know with 100% certainty. I would put 75% certainty, in my opinion. There's 75% of the time in these type of situation, market retest. So you can wait for 220, and 3 out of 4 times, you will be rewarded, and the market will drop to 220. But what happens in 25% where it does not reach that level? And let's say we break through the 264, and you wait for 220, and you wait for 220, and it never reaches 220, right? So then that's where I would suggest you put only some percentage of your trade at 240, because I can, I envision scenario where we never break 240. It's not never, but not in the next couple months. Right? There is a scenario where the market is just going to hold the 240 level. The amount of liquidity has been increased, pumped into the system, the small businesses, I mean, it won't happen today, but in the next few months, people will have a lot more money than they ever had before, right? If the scenario where people go back to work in May, start going back to work in May, start, factories reopen in May, June, people's, life becomes normal again, we will never reach 240. So you might indefinitely wait for 220 and never enter the market. So you don't want to be in this analysis paralysis type of situation. So Diego, hopefully it makes sense. Right, so trading is about your opinion and how much money you're willing to invest. You should never invest 100% of your money. Doesn't matter how strong your opinion is, just realize it's just your opinion, nothing more, nothing less. You're much better off going and trying to predict, there's a great event, not great, but game theory, right? If you study game theory or search on game theory, it's irrelevant what I think. It doesn't really matter what I think. I could be completely right, but the market can still go completely the opposite direction. Game theory is about all the participants in the market, and based on the participants in the market, where do we think, let me just forward this, right? So game theory, theoretical framework for conceiving social situation among competing players, and in some respect, game theory is a science of strategy, or at least optimal decision-making of independent and competing actors in strategic settings. The key pioneering of game theory were mathematicians John von Neumann and John Nash. So the market, retail investors are a very small percentage of the market, right? We don't drive the market, and what my opinion is irrelevant actually in the prospect of game theory. I'm just a small universe, So the market consists of government, right? The government is the biggest buyers. So if you want to predict what will happen to the market, you probably should try to predict how well US government works, how efficient they are in providing the small business loans and sending money to people, right? If you don't believe in US government and you think it's going to be like 2008, like during Obama administration, where it's going to take months to deliver these checks and loans to people, then your opinion should be we're going to be in multi-year recession. So you don't need to try to predict, what Vlad thinks, whether Vlad is right or right. You need to try to predict what the biggest player in the market are doing. On one hand, you have US government, right? On the other hand, you have sovereign funds, you have pension funds that have billions of dollars. You have wealth fund, the 3% of people that have 90% of all the money, right? The wealth managers, UBS, Brinson, Fidelity. You have to predict what big hedge funds that short-term drive volatility and try to drive the market to the downside, right? There's still a lot of short sellers in the market with large capital, right? We have Aikman, of the world, and other hedge funds that can go out on the news and just say, listen, Armageddon is coming, and this is going to be worse than the Great Depression, right? And the market. So game theory talks about people that are participating in this market and who has what opinion. So you need to try to predict what each of the different players will do, right? And that's not a trivial task, right? But that's what you should try to do. So it doesn't matter what Vlad thinks, it matters what other people think and what they're doing. And you need to go through a scenario where if US government wins and they are efficient, right? They're already providing a lot of liquidity. They said they're gonna, help out airline industries and energy companies. And if you believe that happened quickly and efficiently or relatively terms, then 240 will never break, right? If you think that this is a big, large, bureaucracy and it's going to take them months to get their act together, and small business loans, even though they're open today and the site will crash, and but we'll see that, and that's, I think, hopefully that's a good answer to your question. Yeah, TJ, day trading, It is safe as long as you're very disciplined and you have your key stop levels, right? You don't do dollar cost averaging on, on day trading, right? Day trading, if you get into a trade, let's say you wait, let's say market drops to 246, in the next, I don't know, hour, it drops to 246, and then it crawls back up and you go long, like this type of scenario, it makes sense, right? But you have to have a clear stop level that if it drops below 244, you don't do dollar cost average, right? It reached yesterday's low, that's your absolute stop level, right? So 244 is your absolute stop level, 253 is your absolute, stop level. Right now we're 248, right? 5 points to the upside, 5 points to the downside. I mean, if you guys, I would say it's a flip of a coin. You can flip of a coin and market can jump to 252 or it can drop to 244. But I would wait. If it reaches 253, I personally would go short, right? We weren't able to break 253 here, weren't able to break it here, weren't able to break it here. Next time market reaches 252, I would go short. And you have well-defined stop levels. If it breaks 254, you're out, right? Because market can quickly jump to 260. So from that perspective, day trading is safer, right? Because if you go long here at 248 and you leave your position overnight, and let's say a number of cases in Italy doubles over the weekend, then the market is going to be at 235 when the market opens. All right, Kevin, appreciate your comment. Chris, sorry, I forgot. Just repeat your question. I'm not sure what this means. Leon, yeah, I'm not going to get into politics, but I do want to acknowledge, I don't know about Italy or Spain, but I think objectively, if you look how long it took the money to get into the system in 2008 versus how long it takes the money, and still to be determined, but we are moving, the US government is moving at much faster pace than it did before. Do average US citizen have trust in US government? That's very debatable, right? Half of the people probably say absolutely not. Half of the people will say absolutely yes, right? And this is politics, right? If you're Republican, you're going to say yes. If you're Democrat, you're going to say no. But you need to put your biases aside, right? Assuming you're a Republican, assume that government will not be as efficient as you really believe. And if you're a Democrat, just at least assume that government is not as bad as you think and it can actually move faster. So these are where your biases make decision for you, right? You don't make decision based on analytical data. You make decision based on the way you're raised, the way your background, right? In Spain, in Italy, nobody trusts the government, right? They don't trust the government. So I understand that it's very hard to trade with the hope that the government will, but at least if you don't believe in your government, assume that they might move much faster than they have before, right? Spanish, people in Spain, people in Italy, they're resilient, right? They've seen adversity and they know how to get together in the face of adversity. And just in general, people do work better. And you have to at least assume that they can overcome the adversity. And if we all put together and we think about each other more than we think about ourselves, and we care about our community, we care about our family, then we can all get together and overcome this, right? Common thinking. Yeah, no, Chris, all the messages, the SMS message comes from me and our team. They don't come from other traders. Angelique, I know your background. Okay, thank you for your comments. We don't trust Springfield, Illinois. Okay, I'm not going to talk about politics anymore. I know I'm gonna offend some people, so I'm trying to be neutral. All right. Yeah, Kevin, Sunday session. So question was on Sunday session starts at 5 p.m. Central, 6 p.m. Eastern. So you can look at the futures data, right? You can look at oil contracts or S&P mini, right? The June contract, they will start trading. They will start trading at 10 p.m. 5 p.m. on Sunday, so you can see. Osama, thank you very much. All right, guys, it took a little bit longer, but I appreciate your time. I actually look forward to these events every single day. I go to an office. I'm here by myself. I practice social distancing, but it gets, I look forward to you guys. And all right, thank you very much, everybody. We had a record attendance. I really appreciate that. Stay safe. The most important, stay safe, stay healthy, take care of you, take care of your family, and go through this exercise with doing a live trading room environment. Just imagine you're in, Leon, you're from Mallorca, right? So imagine you're on an island near Spain. It's July. You close your eyes, you're on the beach, you have a wine of, you have rojo, right? You have a glass of red wine, rojo, and you close your eyes and the sun is shining and you can feel the heat, and just keep believing and keep looking and imagining that scenario, right? And try to make it as vivid as possible. Actually try to feel the wind touching your face and the sun shining, and just do this 3 times a day. Commit to the next 3 months to do just that 3 times a day. Feel, Leon invited everybody to join his house on the island, and we're all sitting there. We're all, drinking a glass of red wine, rojo, and we're imagining we can hear the ocean, we can feel the wind, and we do this 3 times a day. And you will see that by July, things will be better. All right, guys, thank you very much. Enjoy your weekend. Recharge, recharge your batteries, your emotional intelligence, and your emotional capital, and I will see everybody on Monday. Enjoy your weekend, practice social distancing, and stay safe. Thank you.